Hey, friends. Dan Passarelli here. I hope you're doing great today. I want to switch my good. There we go. Check, check, check. Hold on a second. Check, check, check. Let's make sure you can hear me. If you can hear me, please go to the Q&A box and type the word Tuesday. Type the word Tuesday. All right. Thank you, Secret Agent Man. Thank you, Justin. Thank you, John, David, Dan the Man, Dan McMahon. All right, folks. Today, we've got an interesting presentation. You're going to like this. You're going to like this a lot. Thank you, Esty. You're going to like this a super lot. The straddles are such important things. And so many people trade them wrong. We're going to get into it. Before we get started, I need to point out options are not for everyone. Please read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. So here we go. I see some of our regulars, our market taker / Firstrade family members here. And I love to see that. And I also see some new folks, and I love to see that too. So for those of you who are not familiar with who I am or what I do, allow me to introduce myself. My name is Dan Passarelli, and I am an author of 3 of the most popular option trading books. One, I can't prove that yet because it's not out yet. But Trading Option Greeks is the one that I'm very well known for. It's been called the Bible of the Greeks, and it's in the top 5 options books ever written, according to many, many lists. And man, I write a lot of other stuff too. Holy crap. I write on Substack weekly. I'm going to have that this week's come out later today. So make sure you go to my Substack, Wealth Building with Options. Substack.com and get that. This article, if you ever wanted to really deeply understand how banking affects inflation and the Fed and really the nuts and bolts of it in complete lay terms, I'm kind of proud about this article, to tell you the truth. You should go and check it out. I'm also a trader. I trade every day, and I've been doing that for many, 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 many years. Traded on the floor of the Chicago Board Options Exchange, Chicago Board of Trade, CME Group. Now I trade in a retail account just like you. I'm also the president and founder of Market Taker Mentoring, which is the leader in option trader education. We have student traders in over 50 countries. And holy cow, man, we got some really, really great stuff. We're actually right now in a round of accepting one-on-one training applications, which we don't always do. If you're interested in that, now is the time. Now is actually a great time. Where can you find those writings? Just go to Substack and search for either me, Dan Passarelli, there's how you spell it, and go to Wealth Building with Options. Wealth Building with Options. And I'll type that answer in here. Wealth Building with Options.substack.com. Julian, click that link that I just sent and let me know if it gets you there. If not, I'll pull it up on the screen and copy and paste it in there. But that, well, let me know, please. Go ahead and click it now. Also, I am a trading industry collaborator, I guess, for lack of a better word. And I work with lots and lots of trading firms. I've knew this over 30 years, and anybody who has been in an industry for over 30 years, you know all the key players in your niche of the industry, right? I mean, it's 30 years, unless you work under a rock and, don't communicate with the outside world, everybody in the industry. And so that's who I am. I work with all the top options friendly brokers. I work with all the options exchanges, probably in the world, honestly, in at least some small capacity, but with many in a large capacity, like the Chicago Board Options Exchange. I taught classes for them. Tuesday. Hey, Lewis. All right. Sound had to travel a long time through that string between the tin cans, I guess. Huh? All right, good. All right. So yeah, so that's me and what I do. But there's also important things in life. Oh, the link worked. Good, Julian. There are also important things in life. Trading is important. Trading can give you financial freedom, right? Trading can change your life, help you compound money faster. Gosh, trading's a big deal. But it's not the most important thing, is it? The most important thing are things like family, people you love. What's more important than that? And so, yeah, I'm a family man. Got my wife, Kathleen, who actually I work with too. How about that? She runs operations for Market Taker. She is a big deal. And I've got my 2 adult children who going over their house for dinner on Friday. Do you believe it? They live together. Isn't that the weirdest thing in the whole world? They live together. You would think a brother and a sister would not live together, but they do. And they have a roommate and they all get along. Now the roommate's like our, stepchild or something. She's great. And I got my 2 little dogs who I think my wife just took him to the groomer. Got to do that. And I am a runner, foodie, traveler, and musician. All right, enough about me. You don't need to hear about me. I need to hear about you. Let's talk about the important person here. You. I want you to get everything out of this as you can. So when we're done here, if you didn't go to, if you want to read some really deep articles where I kind of drill down and try and make it accessible for different people, I'm proud of my work at wealthbuildingwithoptions.substack.com. But I'm all, if you are interested in improving your trading and thinking about one-on-one coaching, go to markettaker.com, click join free, or just email me too, dan@markettaker.com. And I will show you how you can apply for one-on-one coaching. When I say apply, basically we'll give you a call. Our trader success team will give you a call. And if it's a good fit, if you're a good fit for us and we're a good fit for you, then we'll invite you to join the program. And if not, that's totally cool too, So just go to markettaker.com and then click on, hold on a second. And then click on join free in the top right-hand corner. John says, I did a webinar with you on calendar spreads and you had a spreadsheet for finding the setups that met criteria for being potentially good versus losing trade. I've deeply regretted not signing up to get that spreadsheet. Can I please get that spreadsheet when I sign up today? Yes, you can. That's our time spread calendar spreads, or our earnings calendar spreads. You can do that. That class is going on now. You just missed one day of the live, no big deal. It's at 3 to 4 o'clock today, Central or Eastern time. I know you do. Do you have the link to sign up for total earnings domination? I gave you that one too. Here, markettaker.com/TED. That's the sign up page. All right, let's get on to the issue at hand here today, friends. Trading straddles conventionally. And I'm going to give you a hint. I'm going to steal my own thunder over here. The conventional way, like when you read a textbook on how to trade straddles, and if you trade it that way, you are going to lose money. Conventional straddle trading doesn't work. And you'll see why. First of all, I know we got some newbies here. So what the heck is a long straddle? Well, a long straddle is when you buy a call and buy a put. Both have the same strike price and expiration, both on the same underlying, obviously. So if I buy a call when the stock goes up, I can make money on the call infinitely. As high as stock goes, I keep making more money the higher the stock goes. But if I lose on the call, I only have a limited loss. If I buy a put, the lower the stock goes, the more money I make. But if it goes up, then I have a limited loss. So like you would think, wait, if I buy a put and buy a call, don't they cancel each other out? No, because of the nature of long options. I have limited loss on both, but I have unlimited profit on either. So this is really, it's not a bullish or bearish trade. It's a bullish on volatility trade. And it works kind of like this. Because I own a call and a put. Let's say I buy the February 80 straddle at $4.75. Well, let's say the worst case scenario happens. There's zero volatility. The stock is, I probably bought this when the stock was at 80. I'm sure it wasn't exactly at 80, but close enough, right? Bought this when the stock was at 80. And let's just say it stayed at 80 or maybe moved around a little bit, but at expiration, I hold it all the way till expiration, it's still at 80. If it's exactly at 80, well, really it's pinned to the strike. And so, well, I probably wouldn't choose to exercise either the call or the put, right? I wouldn't choose to exercise either of them because there's no advantage to it. And I would lose the $4.75 I paid. But if the stock is above 80, I lose on the put, that would expire at expiration. But the call is going to have some value. If it's at trade, if the stock is trading at $80.01, put's going to expire and the call is worth 1 cent. So I lose $7 or $4.74. But if it's trading at 81, then I lose whatever I paid for the put. Call's worth $1. I only lose $3.75. Where's the break even? Well, it's when the stock is at $84.75. That's when the call is worth $4.75. So that's my break even. Anywhere above there, I make money at expiration. Conventional, right? Below 80, if the stock goes down, it's got to go $4.75 below 80 for the put to make the trade break even. So the break even on the downside is $75.25. Right? The long straddle is buying a put. Oh, a long strangle. So wait, before we get to the strangle, this is what the textbooks tell you. This is all the textbooks tell you. You trade this way, you are going to lose money. Not going to work. Let's talk about strangles too. Just because they're kind of the same thing. That's when I buy a call and I buy a put, but the put has a lower strike and the call has a higher strike than the put. You typically they're both out of the, I mean, you're gonna set this up with both of them out of the money. So the stock's in the middle between the two strike prices. It's also bullish on volatility trade, but it works kind of like this, right? If the stock is here, let's just get all these lines on here. If you hold this, if you buy the February 75 puts, buy the February 85 calls, and hold it till expiration, if the stock is between 75 and 85, well, both of the options expire, right? If it's above 75, the puts expire. If it's below 85, the calls expire. So if it's between there, both of them expire and you lose what you pay for it, right? But if the stock is above 85, then what? Well, I lose whatever I paid for the put, but if the call is worth more than $3.50, I'm going to make money on the whole overall package. If the stock is below 75 by more than $3.50, I'm going to make money on the whole package. So it's a similar trade. It's just you risk less dollars, but it's actually got to move a little bit more because the strikes are farther apart. All right. So now let's get into the nuts and bolts of this here, huh? Get under the hood. So this is a hypothetical trade, although it's a pretty recent screenshot, but I'm not advocating this and the prices are not really current. Let's say you are bullish on volatility in NVIDIA. You just read this out of a textbook and you say, oh, hey, if the stock moves a lot, I make money. So I'm going to buy a straddle. So you buy the 187.5 calls at $7.30, buy the 187.5 puts at $7.25. You're in the same expiration, the February 20th expiration cycle, which in this hypothetical example has 25 days until expiration. So how much am I paying for the straddle? Well, 725 plus 730 is $14.55. So unless NVIDIA moves more than $14.55 in the next, well, by expiration, again, assuming I'm holding it till expiration, which is a dumb assumption, but that's what we're assuming. Stock has to move $14.55 above or below the strike price. And so that's kind of a big move, right? Think of it in percentages. 1455 divided by 187.50 is what? 13 or not 13, about 8% or something, right? 14.55 divided by 187.5. Yeah, 7.76%. So like I said, 18% or 8%, right? I mean, that's pretty big move for 20 days. Now, has NVIDIA ever moved that much in 20 days? Absolutely. But, you know, sometimes you get the up moves and then the down moves and then the up moves and then the down moves. And there's a lot of offsetting of each other. So just because the stock can move 2% in a day doesn't mean, no, it's just going to take 4 days. That is a fallacy and a half, my friend. It's hard to bust out of an 8% range in 20 days, even for a stock like NVIDIA. Most of the time. Not saying it's a terrible trade, but I'm not saying it's a good trade. If we look back, here are those break evens, man. If we go back to August, over 6 months, it has almost always remained in that range. There would have been, over a 6 month period, there would have been 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. 19 days over 6 months that you could have made money. So less than 1/6 of the time, right? Figure there's 21 trading days in a month. So if you timed it exactly perfectly, you had a 1 in 6 chance of making money. But, that's counting like this day here where like it was below it for a second. This day here was below it for a second. This way here was below it for a second. This day here, you would have lost money for sure. The only time you would have possibly had a shot is if you took it off at the right time here or here. There's really only 2 times where you had a fighting chance of making money. It doesn't work. It doesn't work when you do it the conventional way. So we need to do something different than what the typical textbooks tell us. If I wrote a textbook on this, I'd tell you the truth. I'd tell you exactly how it works. But nobody tells you exactly how it works. I don't know if they want you to fail, or I don't think they want you to fail. I think they just don't know. There's a bunch of bozos on YouTube who, say they got some secret way of doing it, but they were never actually professional traders. They don't really know. I've been doing this 30 years. I got it figured out and I'm sharing it with you. So what we need to do is use volatility charts to quickly filter if a straddle is likely a good candidate. The premise is trading with edge, okay? Because here's another thing that people don't tell you. And this is the more controversial thing. Like anybody who tried trading straddles has come to realize the textbooks don't tell you the truth. But I would go toe to toe with any professional in this business on bullet point 2. Volatility is always wrong. It's always wrong. It's close sometimes, maybe even a lot of the time, but it's always wrong. And so that means you have an opportunity to make money because you can get an edge. You can wait until it's cheap and buy things that are underpriced. It's kind of like if you go to the hardware store. Remember when there were hardware stores before Home Depot and Menards and all that? You would go to your Ace or your Ben Franklin, or wasn't there one called Key? Like Key, Key. I think there was one called that, right? Ace Hardware, Ben Franklin. Are there any other hardware store chains? I think Key was one. Okay, so anyway, you go in there, it's got that hardware store smell, and I'm talking to the old people here like me, okay? If you've got gray hair, I'm talking to you. If you are fortunate enough to be my age and not have gray hair, I'm still talking to you. If you know what 6'7" actually means, I'm not talking to you, right? I don't know what it means. I don't have any idea what it means. But you go into your local Ben Franklin's, right? You go into your local Ben Franklin's, and it's got that hardware smell. And there's just cabinets and cabinets full of stuff, and you got the key maker there, and maybe even got a knife sharpener over there. You got the people who do the things. And you notice that when you buy stuff there, there's this one cashier who is just ditzy, right? And they never ring stuff up for the right price. And so you're going to buy a padlock and it costs $6.12. And they type in the wrong thing because I don't know if they're new or they're just ditzy or what, but if he rings it up at $7.56, you're going to say, no, I'm not going to buy it. No, that's not the price. And then, they'll fix it and they'll change it. They don't do that in the market. They just say, well, no, here's the price, even though this is the price, this is the value. But every once in a while, the cashier, when you're trying to buy the $6.12 padlock, the cashier rings it up at, $4.15. And you're like, yeah, here's my credit card. Run it through really quick before you realize what you're doing, right? No, you wouldn't do that. I wouldn't do that. You would say, I'm sorry, you've made a mistake. Allow me to correct you, and you should charge me more, right? And yeah, maybe arguably morally you should do that at the hardware store. But the market, forget about that, man. You're competing against cutthroat killers. Not really. I'm being hyperbolic, if you will. But you're competing against some of the, most cutthroat business people in the world, man. They will, if you make a mistake, they will capitalize on your mistake. And there is not a moral clause there. That's what you're supposed to do as a trader. You're supposed to look for mispricings. Jesus, just lost my light. All right. Now I'm getting some sort of weird underlight. Is it like when you're telling a story at the campfire and you hold the flashlight under your face? Is that what's going on here? I don't know. Anyway, sorry about that. I got a little excited over here. So look, that's what you're supposed to do. You're supposed to look for mispricings in the market. And if you just say, oh, well, I think the stock's going to have volatility. It looks like it's volatile. I'll buy a straddle. Oh, you're going to lose money. But if you look at what the value of the straddle should be and only buy it when it's underpriced, now you got a way to make money. Now you got a way to buy all your crap at Ben Franklin's at a discount. If you were immoral. So here's the thing, though. If you look at the price of a straddle, you're never going to know if it's overpriced or underpriced. I've been doing this 30 years. I can't just look at the price and say, oh, well, that's overpriced. You've got to convert price into volatility. Maybe I can fix my light while we're talking here. You've got to convert price into volatility. Oh, look at that. I'm like a regular Mr. Fix-It over here. Because volatility is the normalized price of options. Ooh, I got a little trick here. This will never happen again if I do it this way, right? No, that's not true. Screw it. Okay. Volatility is the normalized price of options. If you're taking notes, write that down. If you're not taking notes, I don't know. You probably should take notes, honestly. You either write on paper, you have a Word doc spreadsheet. Probably better to use the Google Drive, even though I hate Google, but it's a lot easier to use the Google Drive. But here's the thing. You've got to know how to analyze volatility in order to know if it's overpriced or underpriced. And if you don't, then everything I'm saying is not going to do you any good. You got to know that. Lucky for you, I use what is called the 1, 2, 3 volatility analysis. Now, if you don't have volatility charts, you can just Google volatility charts and you should be able to find some free service that'll provide them. But here's what you do. Step 1 is you compare today's implied volatility versus today's historical volatility. If today's implied volatility is below today's historical volatility, and I'm talking about the implied volatility in the option chain. We looked at that on Firstrade option chains before. If the implied volatility in the option chain of the option you're considering buying a straddle at that strike price, at that expiration, is below today's historical volatility, that is one indication, it's not the final, but it's one indication that implied volatility might be underpriced. If today's implied volatility on the volatility chart is towards the low end, like in the bottom third of the 6-month volatility on the volatility chart, comparing implied to itself over the past 6 months, if it's in the lower third now, that's the second indication that it's cheap. Number 3, do your due diligence, find out when earnings are, find out when, potentially contested Fed announcements are, like, oh, geez, will they or won't they this time around? Usually we kind of have a pretty good idea, but I think we're going to be getting to the point where there's going to be some, geez, Louise, I don't know if they're going to cut rates or not. I don't know if it's going to be 25 or 50 basis points. I think those might be coming soon. You want to ideally have one of those events coming up. You want to have a reason to believe that the volatility of the stock will increase above and beyond what it's been, and or that implied volatility will increase from where it is. Step 1, step 2, step 3. You do that, and that's going to help you a ton. Luis, maybe Luis, the Bollinger Bands can be used to analyze the volatility in options. I mean, you would use the Bollinger Bands on the stock chart, not the options chart. You pretty much never use an options chart, but Bollinger Bands does indeed give you a measure of volatility, as does average true range, as do a number of things. You can also use them, but I would recommend doing it the way I described it, because that is a very options-centric volatility analysis. It's an option trader-centric volatility analysis. You've kind of got to do it the way I said. And then you can also overlay Bollinger Bands. I mean, the Bollinger Bands or average true range can be something you work into step 3 of this, but the first 2 steps are essential. Good question, man. Good question. You are welcome. So, oh shit. Straddles and volatility permutations. A specific volatility value. Let's talk about what I mean by this first. Here, let's make this super real, okay? Got my Firstrade thing open here. Platform. So these are the spiders. And we're going to look at the Greeks analytical. And we'll go out to let's look at February 20th, right? So here's the implied volatility. It's in the option chain. If I'm going to buy a straddle in here, how much am I going to pay? Well, we can look at it, and we should look at it. 696 strike. Paying 995 here on the calls, paying 831 here on the puts. Add those together, you get whatever it is you get. $18.26, right? $18.26, I think, right? But that's not the important answer to what you pay. It seems like it should be. But the real important question to what do you pay is, oh, I'm paying a 12.7% implied volatility on the call and the put. If this is your first time looking at volatility and option chains, you might be thinking to yourself, that's weird. Dan must have been, before class here today. What's going on here? How do you pay a 12.7% IV? That doesn't make sense. Is Firstrade going to take 12.7% IV out of my accounts and, put that towards this thing? Well, look, when we only look at the price, we have the direction that affects the price of both the call and the put. We have time passing that affects the value of both the call and the put. We have expectations for interest rates affecting the value of both the call and the put. Expectations for dividend, future dividend streams affecting the price of the call and the put. We've got all these different things that affect it. You'd have to be a computer with an options pricing model hardwired into your brain to make any sense out of the option prices, because one change in one can be offset or exacerbated by a change in another one, and then there's another one. It's like 5-dimensional chess. But if you only look at the implied volatility, you're normalizing all those other things. You're saying at this snapshot in time, the supply and demand measure for implied volatility or for these options is 12.7. If time passes and I look at this tomorrow, it might still be 12.7 because we're normalizing it and saying, forget about time. We're just looking at the volatility impact. Volatility impact is the supply and demand impact. If people are buying it up, they're buying a lot of options in there, it raises the price of the options by raising implied volatility. People are selling a lot of options, it lowers the price of the options by lowering implied volatility. This is your best friend when you trade straddles, when you trade any options. All right? I'm telling you like it is, man. I don't know why other people don't tell you this. I don't know why. But this is the big secret to success in straddles and options trading in general. Before I go on, Lewis, do I have your 1, 2, 3 steps correct? Compare today's implied volatility with today's historical volatility. If implied is below historical volatility, that means it's an indication implied volatility might be underpriced. Step 1 is correct. Ding, 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 ding. Step 2, compare today's implied volatility with the last 6 months of, with the last 6 months of with the last 6 months of implied volatility. Compare implied to itself. So step 2, the little tweak. Take the word historical that's in there twice and change it to implied, and step 2 would be right. Step 3, find important dates where implied volatility is likely to increase. Yeah, that's part of it. Basically, you're looking for any reason why implied or historical volatility might increase during the life that you're holding on to the straddle. Yeah. Thank you, Lewis. I'm glad you put that. I'm going to reply publicly here. Step 2, change historical to implied twice. Step 3, any reason why vol implied or historical might increase is good. You're welcome, Lewis. That's all we're getting today. That's all right. We're getting all Lewis's talking. Luis. Do we have any Louises here? How about a Louis? Francais. Oui, oui. All right. So that's the secret, man. And the thing is the secret is not a secret. Anybody who's really traded options on a higher level as a professional knows this. Okay. They just don't tell you it because they like noise in the volatility market. They like people saying, I don't know. I mean, it's probably going to be volatile. So like maybe I'll kind of, buy a straddle. And that just messes with the volatility level and gives them potential opportunities. So a specific volatility value, like we talked about, 12.7 in the last example, has nearly infinite volatility permutations that can return that value. It can go just straight up every day, unlikely. It can go up most of the days. It can go up and down every other day. It can go down 20% of the days. It can go down for a week and then up for 3 days and then down for 2 weeks. Anything can happen. Retail break-even straddles limit volatility permutations to trending volatility. It's just got to keep going enough to break even at expiration. So setting up, how are we doing on time here? Okay, we're doing great. We're doing great. I'm perfectly on schedule. Setting up break-even straddles, we must compare straddle break-evens with historical price action. Okay. When I say break-even straddles, I'm not saying, oh, I'm trying to break even on this. I'm saying we draw a P&L diagram and here are break-evens. My philosophy is it's got to be above here or below here, the break-evens. So we need to do like I did on that NVIDIA chart and draw those lines, at least in our heads, and say, wow, it's been like in this range almost every day for the past 6 months. I'm almost certain to lose. I don't think I'm going to do this. Or, wow, it's really busted out. I'm going to do this. Or, oh, there's a reason why I think it will bust out. I'm going to do this. We must only trade straddles on stocks in which the price was outside the break-evens in recent past, or we have some really darn good idea to believe that things are going to be different, which is a pretty hard thing to do. The break-even straddles work best with trending volatility. Very, very, very almost impossible to find a candidate to make money with. A more delta neutral trading philosophy is this. Market makers, also called dealers, and other professionals hedge the delta and scalp gamma. Delta is the biggest risk in any option trade, and it's the only Greek that can be neutralized without affecting the other Greeks. This is trading option-based risk, okay? So the gist of delta neutral trading is this. You make an, excuse me. I've been talking a lot lately. And in Illinois, it is dry here. Do you know what the temperature is where I am right now? You want to know what it is? You want to take a guess what it is? I'm in the south suburb of Chicago. It is a balmy 16 degrees, which is a great deal warmer than it's been the last 3 days. Oh my goodness. Monday, it might actually be just freezing and not below freezing. 32 degrees Fahrenheit, which is 0 Celsius centigrade. So we make an option trade and I hedge with stock based on my delta. So Let's say I buy 100 calls with a 50 delta, so I short 500 shares. No, 5,000 shares. Wait a second now. Oh, yeah. Right? Because 100 calls that have a 50 delta, if I buy those, I'm getting long 5,000 deltas worth of stock, right? So if I short 500 shares, now my delta is zero. When the stock moves, gamma causes the delta to change, so I need to adjust my delta. Delta is neutral when it's hedged, but because I still have gamma, that's why I hedge, but I also have theta and vega positions. Professional traders consider all options straddles, right? Isn't that crazy? But they do. So you need to understand put call parity. Put call parity basically says stock price equals the call price minus the put price plus the strike minus dividend plus strike minus interest plus dividends. But if I just realize, yeah, I'm using the same strike for both, I'm factoring in interest and dividends, I can just kind of like cut those three out for right now and say long call equals long put plus long stock. Short call equals short put plus short stock. Long put equals long call plus short stock. Short put equals short call plus long stock. What's that last one? Anybody have a feeling for what that last one is all about? How about cash secured puts versus, yeah, thanks, Baron. Boom. Baron on the board. You're not even named Lewis today. Maybe next week. Covered call. Short call plus long stock is a covered call. Short put with cash is a cash secured put. Covered calls and cash secured puts, when they have the same strike, are synthetically related. Or synthetically related, let's just say. I always tend to try to and usually succeed in choosing my words very, very carefully so that I'm 100% accurate. So look, this is a graph, P&L diagram of a long call. This is a P&L diagram of long stock plus long put. Same risk reward. This is short call and short stock and short put. Long put or a protective put or a, oh wait. Long stock plus long put, protective put, same as long call. There's another one to look at, right? Cash secured put, covered call, same shape graph. That noise just started happening. I don't know what the heck it means. But I think it might have something to do with my Google Calendar because I just started using Google Calendar. I've been using the calendar app on my Mac, and it just doesn't talk to other programs. It's just been frustrating. So I'm going through the painstaking and time-consuming process of moving over to the Google Calendar. It's going to make everybody's life easier, except for mine. Maybe mine too. I don't know. But I don't know what that sound is. Anyway, so a straddle is you buy a call and you buy a put, right? But I know that a put equals call plus short stock, right? Long put equals long call plus short stock, synthetics. So a synthetic straddle is actually what we just looked at. You didn't know that, but it is. It's long call plus a synthetic long put, which is long call plus short stock. So I could, hold on a second. Hold on. Oh, geez. I don't know if you guys notice this about me, but I am very particular about things. And I like things in my presentations to be exactly lined up. And when I have other people help me with my presentations, they don't always have the same standards that I do. And that probably means that I have psychological issues, which is probably true. But it ends net result in a better education for you. So I'm going to keep being crazy. So let's say the stock is at about 60. I buy 10 of the February at the money 60 calls, and I buy 10 of the at the money February 60 puts. There's your straddle. But I could do the same thing synthetically. Buy 10 of the February 60 calls plus the synthetic put. Buy 10 of the February 60 and see. Now there's my, oh, no, that's right. Buy 10 of the February 60 calls again. So now it's sold at 20, but I'm short 1,000 shares. Long 20 and short 1,000 shares, which is kind of like just hedging a 50 delta, right? So this is a pure volatility strategy. It's trading gamma theta, your realized volatility, and vega. It's called gamma scalping synthetic straddles. Now, I know this is a much more advanced topic than some of you might have been expecting. Sometimes I do some of these Firstrade webinars, and it's a pretty simple topic because I know there's a lot of newbies here. Sometimes I go deep, and that's what we're doing today. So those of you who are new here, if you're like, oh my gosh, my head's going to explode, I'm never going another one of these again, just know that some of them are a lot more basic, and, you know, bookmark this, you know, go to Firstrade's YouTube page, bookmark this one, and watch it later after you get boned up a little bit more on volatility and synthetics and the Greeks. So what we do is we buy or sell stock to neutralize the delta on the straddle that results from gamma. This is options-based exposure. We need to adjust or re-hedge often. Market makers, dealers, are well capitalized and have liberal margin. First of all, they all have a backer. Market makers are, they used to be, but they're not anymore, some individual person who has $1 million and stands on the trading floor. These days, you can't even do it with $1 million. You got to be mega capitalized. And to boot, you know, maybe you need 10 million bucks and you have 10 million bucks from a backer, but you also have super liberal margin. So they can trade 10 times, 20 times more than you or I in a Reg T count can trade with the same money. And they have more money. So gamma scalping is difficult for any retail trader to scalp stock while carrying option positions. You can fake scalp straddles by legging out or into the straddle or adding back to the straddle position. But that's pretty tricky too. I wouldn't recommend that either. We must set up the trade based on volatility and stock price. Based on volatility, the stock price chart is not really very relevant. That's another surprise to a lot of people, right? You mean I don't look at the stock chart? That is what I mean. When I was a market maker, gamma scalping, that was my thing. I would gamma scalp everything every day. I did that for a career down there. Never looked at a chart once. It's an extremely simple approach once you understand the nuances. And it's More advanced options techniques help, but are less important than the break evens and the likely range. Trending volatility is the best, but I forgot what the strike trick means. But that's everything I have. As a wrap up, your best bet is not, hold on a second. Your best bet is not to try and gamma scalp. It's very helpful to understand gamma scalping, because when you understand gamma scalping, you understand options more deeply and you understand volatility analysis better. So as a retail trader, that's me these days, your best bet is to analyze it as a break-even straddle, but also use volatility analysis as a starting filter. If you can get both of these things working for you, now you've got something powerful. You won't find a lot of candidates, but the ones you find will be good, maybe great. You can kind of fake gamma scalp out only. I would say not really into, by like, if the stock goes up a lot, I could sell some calls. And if it comes back down, I'll sell some puts. But ultimately, if you have a deep understanding of straddles, that's at the heart of really of all option trading. You can kind of scalp out a little bit, but at some point you just want to take the whole thing off and take your profit. I don't really recommend fake gamma scalping, but it's possible. All right. Anyway, friends, that's it. That's all I got today. Hope this was great and informative. I know I covered a lot of super important stuff. So that being said, friends, have a great rest of your day and trade smart. Bye.